Ever feel like figuring out what a company is really worth is like trying to solve a giant, complicated puzzle? I mean, with all the data flying around, it's so easy to get lost. We all use these standard tools, these common metrics, but are they actually still sharp enough for the job in today's world? Or, and this is the big question, are they maybe even leading us down the wrong path? Okay, so let's get right to it. This is the central question, isn't it? The one every single investor is trying to answer. And for this explainer, we're going to treat this whole thing like a detective story. We're on the hunt for a company's real underlying value, and our job is to figure out which clues are legit and which ones are just red herrings. You know, every good investigation has to start with the official case file. And for us investors, that file is the company's 10K report. This is where the company is legally required to lay out the facts, straight from the source. It is absolutely our first stop for gathering evidence. So what is a 10K exactly? Well, the U.S. Securities and Exchange Commission makes all public companies file one every single year. You should really think of it as a comprehensive annual checkup. It gives you this incredibly detailed look right under the hood of the entire business. Now, inside this giant clue file, there are a few sections that every good detective needs to check out. The business section, that's your first briefing. What does this company actually do? Then you've got risk factors. This is kind of like the witness a company is forced to call against itself, where they have to list out everything that could possibly go wrong. The MD&A, that's management's official testimony, their version of the story. And then finally, the financials. These are the hard, audited numbers. For our investigation, this is our ground truth. Now, reading a full 10K, let's be honest, it's a ton of work. So just like any good detective, analysts have come up with a kind of magnifying glass, a shorthand, to quickly size up a situation. And we call these valuation multiples. But right here is where we hit a really crucial distinction, one that finance professor Aswath Damodaran talks about all the time. There's a big difference between pricing something and valuing something. Pricing is using a shortcut, a multiple, to see how a stock is priced compared to its peers. Valuing, on the other hand, is the deep detective work, digging in and calculating what it's actually worth. And believe it or not, surveys show the vast majority of analysts spend most of their time just pricing. So what's their favorite tool for that? It's the price-to-earnings ratio, or PE. It is the undisputed king of multiples. A staggering 88% of equity analysts use it. And it's pretty simple, right? It's just a comparison. How much are you willing to pay for one single dollar of that company's current earnings? Coming in at a close second is the EV to EBITDA multiple. Now, think of this one as taking a wider angle photo of the company. Instead of just looking at the stock price, it considers the whole shebang, the enterprise value, which is basically what it would cost to buy the entire company, debt and all. And it compares that total price tag to EBITDA, which is really just a rough measure of a company's raw cash-generating power before you account for things like interest or taxes. Okay, so we have our magnifying glass, but what if it's flawed? What if there's a serious glitch in the very tools we're all using, a glitch that's making them way less reliable than they used to be? Well, this is the central twist in your detective story. The problem really stems from a huge shift in how companies invest and create value. I mean, decades ago, value came from tangible things you could touch, factories, machines, inventory. In our accounting rules, they were built for that world. But today, so much value comes from intangible things, research and development, building a brand, software code. And here is the glitch. Our accounting rules just haven't kept up. So when a modern company invests a ton of money in R&D or a huge marketing campaign, the rules treat it like a simple expense for that year, almost like paying the electricity bill. This immediately pushes down their reported earnings, even though those investments are meant to create value for years and years to come. And this is not just some tiny accounting quirk. It's a massive distortion. Let's look at the evidence. Take Microsoft. In fiscal 2023, if you adjust their books to treat these intangible investments the way they probably should be treated, as long-term assets, not one-off expenses, their reported net income would have jumped by 14.7%. That is a huge piece of the puzzle that the standard rules are just hiding from us. And this is where the clues start to get really interesting. Look at how this glitch impacts our detective tools. Microsoft's reported PE ratio was almost 35. But once we adjust for those intangible investments, boom, it drops all the way to 30.5. And the EV/EBITDA multiple, that sees an even crazier change, plunging from 24.2 down to 16.9. All of a sudden, the company looks significantly cheaper, much more attractive. And it's the exact same company. We're just viewing it through a less distorted lens. So, Okay, fixing this intangible glitch definitely gives us a clearer picture. But any good detective knows you never ever rely on just one clue, especially when different clues are pointing in totally different directions. And that brings us to our next challenge. Sometimes our two main tools, PE and EVV/EBITDA, can look at the very same company and tell us completely different stories. So, why do we get these conflicting witness statements? Well, it's because these two tools are fundamentally asking different questions. The PE ratio is looking at profit after all the bills are paid, and that includes interest on debt and taxes. So, if a company has a lot of debt, its interest payments can shrink its earnings and make its PE ratio look really high. But EV to EBITDA, it just ignores all that. It's looking at the company's performance before all those financing and tax decisions are made, which gives you a much purer look at the core business's cash flow. This visual right here shows just how confusing those signals can get. Let's take a real-world case, Walmart and Apple. In early 2024, if you only looked at their PE ratios, you'd think, they seem almost identical, both trading around 25 times earnings, and a rookie mistake would be to stop right there. But if you pull out your other tool, the EV/EBITDA multiple, the story completely flips. Walmart's was just 13, while Apple's was over 20. It's a classic case of conflicting evidence, and it's largely because Walmart's debt and tax structure were making its PE ratio look higher than its core performance might really suggest. So, after following all these clues, what's the big conclusion for our investigation? It's not that our tools are useless, not at all. It's that we have to be a whole lot smarter about how we use them. We have to learn to read between the numbers. So here's the bottom line. Valuation multiples, they're a fantastic starting point, a really useful shorthand, but they are not the final answer. The modern economy, with its huge focus on intangible assets, is kind of bending these old tools out of shape. You have to investigate why these multiples are telling you different things, and you have to understand what they might be missing. In this investigation, blindly trusting a single clue is the absolute surest way to get the case wrong. So I'll leave you with this. The next time you're watching TV and you hear a talking head mention a stock's PE ratio as the one reason to buy or sell, what questions are you going to ask? Are you going to wonder about its debt, its tax rate? And maybe most importantly, will you ask how much that company is investing in those invisible, intangible assets that are really driving value today? Because that right there, that's where the real investigation